So this is the 10-year yield. So if you want to if you want to lend to America for 10 years, they'll pay you 1.536%. So you'll get paid that amount of interest every year for 10 years on top of your getting your money back. Looking at it, the trend seems to be down. We keep getting lower highs. So, it was up to 3.8%. It fell, but it couldn't get back up. I mean, in this case, the government would go, okay, we want to borrow $100 billion. Then there'd be a queue of people who'd go, yeah, I'll lend you that. But I want, 3%. And someone else will say, oh no, I'll lend it for 2.5%. And so, you have a market, an auction. The price is determined. So there are a lot of people willing to lend. The interesting thing is, okay, so it's in a downtrend since 2010. But if we zoom back a bit, so I'll look at, say, 10 years. So this is 2007. The trend has been going on for longer. So since 2010, the rates keep falling. When it tries to go back up, it's unable to go past the previous high, falls to a lower low, lower low, lower high. Okay, it didn't manage to get a lower low. At the moment, we're very near that recent low. But if we zoom back, so this is from the year 2000, the trend has been going on since then. Keep going until it runs out. Okay, so this only has data from 1987, 88. And clearly, it's been an ongoing trend. It's just continually, you can nearly draw a line along the highs there. That would just cap all these highs. So now remember, this is a huge market. So it's not like a small peripheral niche market. This is massive, very liquid. So really, we should be looking at this. And unfortunately, I'd have to say, I don't think I've traded bonds at all. Well, not the 10-year bond, not the US 10-year bond, but even other bonds, they would be like, a few days worth of trade, or a one-day trade, or something like that. No significant interest there. Even though we know that the bond markets are where the action is. I mean, the bond market is more than double the size of the equity market, which is where my natural inclinations have been. So I just wanted to bring the bond markets into attention, particularly the fact that we do have this incredible trend. Can it continue? I mean, can it go to 1%? Go to 0%? Does it go on to minus 50%? I mean, like, you know, what's supposed to happen? So I want to do a little bit of have a bit of a look at that. I mean, off the top of my head, I'd imagine, you know, there would be, the interest rate should be related to expected inflation. It should be related to expected growth, all these kind of things. Because, you know, if people thought that on average over the next 10 years we're gonna have growth of 4 or 5%, then you'd be crazy to lend money and be happy with only getting 1.5%. So, you know, I mean, that does give insight into what people in general are expecting. But as I said, I'll look at some of the basic ideas related to interest rates. So what are the basics that you should be aware of, or in this case I should be aware of? Then we can see how can we then trade that. So in particular, looking at the US 10-year, but also looking at, say, Europe, Japan, and emerging markets. Just kind of see how are they different. What, like, you know, which one looks more interesting? Which one can we make more money from? If you have any comments, that'd be great. Just to help out on, you know, whether there are other links, videos that I should look at, books, ideas, how to go about analyzing the bond market. Till next time.